On Thursday, we're going to have a guest speaker for a few minutes at the beginning to talk about the ICT scholarship. So I encourage you to apply for it, but also sit down with me on the application because the essay is really, really important. He'll talk about the deadline. It could be as small as $1,000, as much as $5,000. They're looking for great stories. One of the students in this class won it last year, and they actually put her in an article with her picture, so you get some pretty good press as well. Actuaries, it makes perfect sense for it because they're looking for people who want to work in the insurance industry. So you've got a pretty good story to sell. So they're looking for people that can make a strong case that they want to work in insurance. The better the sob story, the better. You know, I came from a family of 50 kids. I was the oldest. I raised all the other kids. I worked, in a butcher shop for the first, whatever, something that sounds tear jerking. They love it, but just anything that makes it a strong case that you want to work in the industry. That's the purpose of the scholarship, is to bring people into the industry. So he'll speak for maybe 10, 15 minutes. All right. So we're working on annuities, and we're going to handle equilinked annuities and spend quite a bit of time on that tonight and probably Thursday as well. So an annuity protects you from living too long. We're talking about an immediate annuity here. It provides periodic payments to you, usually until you die. So there is an accumulation phase, but to me, the accumulation is not that important because that's just like any other investment. You're really looking on the accumulation phase. You're really looking for the tax advantage. If you die during the accumulation phase, most annuities do pay some kind of death benefit. Usually it's going to be whatever the value of your account is. It can be, I think I'll show you an article here a little later. There are some that are tied to the stock market where they'll either pay you your account value or your premiums back. So if the stock market crashes and someone dies during that time, then, essentially you get the stock market back. And I'm going to show you a guy who figured out how to use that to actually rip off, and not rip off. I think it was actually pretty smart what he did. He found a way to insure a bunch of people about to die so that he could essentially invest in the stock market without any risk. And he made millions off the insurance industry by following exactly the letter of their policies. And the insurance companies didn't like that. They said, we're supposed to rip you off. You're not supposed to rip us off. So they got kind of upset about that. But there are some issues. For most of them, it's not a problem with the more traditional where they just pay an interest amount. You just get your money back if you die during that time. These products have advantage in how they're treated for taxes. Most of them are not tax-free, like life insurance. Life insurance, the person dies, you get the proceeds tax-free. But they are tax-deferred, which can be huge. Usually when they're tax-deferred, the IRS require you to start taking the money out at age 70, although that has changed here recently. So we're really focused on the payout annuity, but when we talk about equity annuity, it's more the accumulation. So we'll see. So it can get confusing whether we're talking about an accumulation product. The industry's focused on the accumulation because that's where they make money. They don't really push the payout, but payout's really where they add value. So a life annuity pays you out until you die. You can make it period certain. Pretty soon here, I'm going to get on the internet and show you UTSA site so we can price some of these. So someone might say, okay, I want you to pay me $500 a month until I die, but I'm really worried what happens if I die a week from now? And the insurance company says, well, we can guarantee we pay you for at least 10 years. So you don't come in with 200,000 bucks and you die a week later and you've lost 200,000 bucks. But if you do that, anything you add to it is going to reduce your monthly payment. So we'll look at that. I'll try to do that. So what's the difference between a pure life annuity where it pays you until you die, even if it's tomorrow, or one when you put a 10-year period certain, and you'll see how much the payments can reduce. A temporary life is, again, very similar. You want some kind of guarantee. The more guarantees you make, the lower your payment's going to be. So like with my mom, if we did an annuity for her, we'd just say, hey, we'll just do an annuity. We want the max payment we can get for you, whether it's 1 year or 1 day or 10 years. That's the way you max out the income. If there's no life contingency, what that means is It pays you $500 a month until you die, but even after you die, it still pays the $500 until some set period. It's really not life insurance products. It's just like any other CD. We're going to look at this later when we talk about the benefit of survivorship. It's a really important concept in insurance, because you need people who die early to subsidize the people who live a long time. Banks can't do that. Investment banks can't do that. The annuitant is the person whose life drives the annuity. So when that person dies, everything changes. That's the annuitant. There is some anti-selection with annuities for payout annuities because healthy people will buy them, unhealthy people won't buy them. The insurance company knows that. They don't do any underwriting. They don't check to make sure you're not healthy. They just assume you are healthy, and they reduce your probability of dying because you bought the annuity. Annuities can be individual. You can buy your own. A lot of them are group annuities. A lot of companies will have group annuities as part of their 401k plan or something else. So they can be group products. Essentially, Social Security is a group annuity. They can be fixed, which is the most basic one. This is the accumulation stage as well. So an accumulation fixed annuity, what that means is you give them money and they'll pay you some interest rate every month until you start taking it out. And it can be variable. That word variable here means the same thing it did with life insurance. That means the policyholder can invest in the stock market. Variable products, just like with life insurance company, they're regulated by the federal government and by the states. And the death benefit here becomes important because if the stock market crashes, you may be able to get more money back. You can make back what you lost in the stock market. What we talk about with annuity, it pays until you die. That's an immediate annuity. A deferred annuity is simply you're saving money during the accumulation stage to fund an immediate annuity. And so then you start getting these little letters, SPDA, SPIA. So SPDA is a single premium. That means they pay one premium, but it's a deferred annuity. So what happens here is someone says, okay, someone just died. I got their life insurance. I'm not ready to retire, but I'm going to put it into an annuity. Here's $200,000, and in 20 years I'll retire and I'll take it out. That's a deferred annuity. Deferred annuity is always an accumulation product. Single premium immediate annuity. This is pretty common. Someone's spouse just passed away. They got the life insurance. Their pension plan went away, so they take that life insurance and they put it into an immediate annuity, and they essentially get that income they would have lost with the from the pension plan. So SPIAs are pretty popular. Usually funded with the life insurance payment. Usually a husband and wife, one of them passes away. You lose some income when that person passes away, but you have this life insurance. You take that and buy an immediate annuity to pay you out some income for the rest of your life. It can be based on one life or a joint life. So depending on how many lives you want. So it's possible that it stops paying after the first person dies. Most of them are going to stop paying after the second person dies. A pure life annuity, it's just when you die, it stops. No guarantees. That's going to give you the highest payment versus period certain. A market value adjusted annuities is, we'll talk about this more when we talk about asset liability management. These products can be very, very risky for insurance companies because I don't know if y'all heard the term hot money, but annuities are really susceptible to people who are running to different places to invest their money. So life insurance paying the best rates, so they go there, and then their rates aren't very good, they go somewhere else. It's what a market value adjusted annuity says. Okay, if you're hot money, you come in and you buy our annuity. If you find a better rate somewhere else, you can take your money out, but we get to adjust it down based on what interest rates did. So if you're shopping rates all over the place, you're going to take a hit. This makes the product much less dangerous for the insurance company, but much less valuable to the policyholder. Why is that so important? Well, when I started at USAA, interest rates were really high. They had annuities that were, paying these really, really high rates. And then rates started dropping and people were like, well, I can do better elsewhere. And a lot of these annuities, the penalty for taking your money out was $25. If they're paying you $5 and you make $9 somewhere else, what are you going to do? You're going to take your money out, pay the $25 and go buy the better rate somewhere else. And they had over like $2 billion worth of those annuities where people could take their money out for just 25 bucks. It was just pretty amazing. They can be qualified and non-qualified. That has to do with the tax treatment. So a traditional IRA is a qualified. So you think about traditional, you get the tax deduction immediately and deferral, but you got to pay tax when you take it out. Most of y'all are probably doing Roth IRAs. There's no deduction up front, but it's never taxable. So you're probably doing Roths. I say never taxable. I don't believe that though. What makes it never taxable? It's Congress never changing the rules. What happens 20 years from now when the deficit's, $80 billion or $80 trillion? There's no reason they couldn't start taxing Roth IRAs. But right now the rules are you do a Roth, you don't get the deduction up front, but you never have to pay tax in the future. But we'll see if they keep that true or not. All right, we're going to talk about equity annuities here, so we can get into some mathematics. This you can incorporate into your ethics question as we get into this. These were introduced when the stock market was doing really well, but got a little volatile, like in 94, 95, 94 especially. And essentially what they said is, hey, let's give people protection from the stock market, not just for living too long, but protection from the stock market. So they're starting to branch out into some products which, most life insurance products are actuarially driven. This is where they're starting to get into some investment driven products. Equity-linked annuities are not regulated by the SEC, although it has come up 2 or 3 times. They should be, in my opinion, but they're not. In fact, it was a foregone conclusion they were going to be regulated. At the last second, the insurance industry got it kicked out and got it protected. So these products are not like variable products. They are not regulated by the SEC. We'll talk about that some, what makes it a requirement here in just a second. So essentially, this is a product you as a consumer could create. I actually like the concept of this product, except for the huge fees insurance companies charge, and we'll talk about that. The problem with these products is how they're marketed. And this is where the SEC comes in. SEC says, hey, if you market an insurance product as an investment, it's an investment and we're going to regulate it. And I don't think there's any question these products are marketed primarily as investment products, but somehow they've avoided the SEC regulation. And what's even worse is the marketing practices are quite questionable, where they'll say, and I'll show you how untrue these statements are, but they'll say, hey, we'll give you the returns of the stock market without the risk. That sounds really good, doesn't it? Hey, the stock market's up 30%, you make 30%. It falls 20%, you make 3%. Yeah, I'll do that. That sounds great. That's not what they do, but that's what they advertise. And this is one of those, again, this is probably the biggest example of complexity. These products, and I'll show you how complex they are. You're going to be pretty shocked at how complex they are. So if you want an example of a complex product in your essay question on the ethics, this would be a good one to do. And you'll see why, because of how complex the language is, and it's practically impossible for the policyholder to know what they're getting. So does the SEC regulate these? No, they're going to ask, is this insurance or is it an investment? Is it a security? If it's insurance, we'll talk about this later, but insurance is exempt from federal regulation through the Rule 151 safe harbor. So why did the SEC say we're going to regulate variable insurance, but not regulate equity-linked annuities? So the first requirement is the company offering these regulated as an insurance company by insurance regulators, and all companies offering these products are. You have to be an insurance company, a life insurance company, to sell these products. So that one's fine. The second one is some of the investment risk has to go to the insurance company. So if you think about universal life products, some of that risk does stay with the insurance company. Variable products, all of that investment risk goes to the policyholder. And if you do that, you'll put it in a separate account. If it's in a separate account, it's going to be regulated by the SEC. Equity-linked annuities are not separate accounts, and we'll see that. By separate account, what that means is there's a whole other set of financial statements. It's not as big as the life insurance financial statements, but there's a whole other set. Everything is set separately because it's the policyholder's money. It's not the company's money. Equity-linked annuities don't do that. It needs to have some guarantees. Equity-linked annuities do appear to provide some minimum guarantees against loss. So that seems to meet the requirement. And they must have some minimum crediting rate, which annuities, equity-linked annuities do that. You don't have to, if you fail, you don't have to fail all of them. And there's really no rules how many you fail, but it's the SEC, this is what they're looking at. The third one, which is where I think this product really fails, is on the marketing. If it's marketed more as an investment than insurance, then they may seek to regulate it. It doesn't mean they get to regulate it, but they may seek to regulate it. They'll look how the sales force is trained, how the company monitors the sales force, what distribution channels are used, and what are its main competing products. Are they stock funds, or are they other insurance products? And the last one is there any mortality risk? Essentially what they're asking, is this really an insurance product, or is it just a pretend insurance company, a product to sell an investment? So I think this third rule, they violate. It doesn't automatically give the SEC authority, but it certainly makes them ask, and they have asked, and they've won. They've lost that battle at least twice, because the insurance industry fights really hard. They have some good lobbyists. All right, so let me show you this. I just put this out on Canvas. On Canvas. If you want to load it and take extra notes on it, it's an article, pretty old article, but it's still true today, and I really like it. It's such a very well written article. It was written by a group that's essentially kind of actuarial-based, mathematical kind of people. So I'm just going to walk you through this. And be aware, there's a good chance your parents are buying this thing, but they won't call it this. The last person I had that bought one of these, I said, that sounds like an equity-linked annuity. Oh, no, it's not that. And she sent it to me. It's like, yeah, that's what it is. So the insurance industry has learned that the term equity-linked annuity, because of Susie Orman and David Ramsey, it's a bad name now. So they've come up with new names for this product, but you can tell it when you see it. So at the time this article was written, equity-linked annuity sales were rising quite dramatically. But he talks about the people buying these can't possibly, and you can tell me if you agree or not once you see this article, but people buying this can't possibly understand these products. They're far too complicated. They are regulated by the states. They estimate that between 15 to 20% of the premium is a transfer of wealth from unsophisticated investors to insurance companies and their sales floors. So you can tell they don't have a positive. I should send this to the guy who sells them in my graduate class. So insurance companies add trivial insurance benefits in their opinion. They say they're disadvantaged from a tax treatment standpoint. We'll talk about that a little bit. And really high costs relative to mutual funds. So here he's talking about variable products, but this applies to equity annuities as well. So this is what he thinks about variable products. Very little insurance. The tax benefit is not that great, especially compared to other life insurance products, and the costs are much higher than mutual funds. That's a variable product. So what they've done is doing the same thing with equity annuities, repackaging them as equity annuities and exempted from effective securities regulation. There are people in the investment world who hate these products. NASD and some others, I'm a member of the CFA Institute. They hate these products. There are some very large investment related groups that want these things regulated and actually want them curtailed quite dramatically because they hate these products. They think they put a black eye on the investment industry. So investors in these products, they don't know the cost they're incurring. So remember, we talked about one of the things in this comparison pricing. You can't compare two products. You don't know if you're getting a good deal or a bad deal. That's always a bad product. So if your parents are buying these things, I can assure you they're not comparing, they're not saying, well, let me look at 4 of these and see which one's better. And you'll see why that's impossible when we go through this. But none of them do that. They buy this, they buy it from the first person who pushes it on them. They don't even think to go price. And you should always, with a life insurance policy, anytime someone from a life insurance company is selling you something, you should always say, how can I compare this to other companies? Make sure you've got the best deal. And see how they answer that. They'll probably get mad at you, but how do you answer that? So how to know your product's better than somebody else's? Can you think of other places where that's the case? When I take my car into a mechanic, I'm pretty much at their mercy. I could take it to another mechanic, but that's a hassle to drive off. So yeah, there's some other places, but I'm not giving the mechanic $250,000. You know, it may cost me a couple of thousand. When I take my bike to the bike shop, I trust those guys, but they probably get some money out of me. A plumber shows up, yeah, whatever. Oh, you got to tear the wall down. It's, but we're talking thousands. We're not talking $250,000, $500,000. So this is on a much bigger scale than those other places where we're bamboozled by experts. It also means that people selling it don't fully understand it either. They understand it better than the person they're selling it to, but this article says it's impossible for them to even understand these products. They couldn't take 3 products and say which one was best. But what can they determine? Their commission. You walk in with $250,000 and they just made a $25,000 commission. They can do that pretty quickly. If you're wondering why they're smiling so big, that's probably why. And they're much larger commissions than other products. Why? Because these are incredibly profitable for the insurance company. So we know something right off the bat. The commissions are high, and even after commissions, they're highly profitable for the insurance company. Is it mathematically possible for this to be a good product for the customer? It's too far. There's no way this can be good for the customer. Too much money has been taken away for other people. So potentially misleading marketing, I don't think it's potentially, I think it's absolutely misleading. Any recommendation to liquidate securities purchase these requires determination that it was suitable. I was having this debate with my student. There's 2 standards, suitability and fiduciary. If you're fiduciary, you have to do what's best for your customer. If you're only under the suitability standard, all you have to do is say someone in the world could buy a product like this in this situation. You have to say they couldn't, there's no way this person would ever buy this product. So with Danya, I was telling you about her story. They sold her a life insurance product. I don't see how that was possibly suitable for her. But all they have to do is find someone in the world, her age and her situation, that could make sense, and they meet the suitability. That doesn't meet the fiduciary standard. Fiduciary standard, you have to say, her interest was the only interest that dominated my decision here. So NASCD has said they do not want their dealers to be able to sell these things. They're too complicated. Their argument is they're too complicated for a majority of brokers. So they don't want it, not just because they're bad for the customer. They don't want them because they're bad for their licensed reps or whatever they're called. So the complexity, just as we talked before, it allows the insurance company to sell these that are much more costly, much less liquid than what you could do elsewhere. And that's what this article is going to do. It's going to compare this to something much simpler. So the insurance industry is fighting back. It's urging its members to write. NASD and SEC claims that equity annuities are not securities, even though they're sold like that by the company. And I love this phrase, that some equity annuities are suitable for seniors, and that not all index annuities have high surrender. So, hey, there's at least one product out there that's decent. So you should let us sell these. Does that sound like a good argument? Like the used car, salesman. There's at least one car on this block that actually drives. You shouldn't close me down. So that's their argument. And you'll hear that. Yeah, there's some bad companies out there, but we're not the bad company. Of course, our customers can't tell which is good and which is bad, and there's no way to fix that. But all right, the minimum rates of return, equity-linked annuities do not guarantee that the investors won't lose money. They do guarantee a minimum rate of return. So you say, well, how's that possible? So you may be guaranteed that you'll make 3% minimum on this product over time. That sounds like you can't lose money, but what if you're up 30% the first year and down 20% the next year? And it says, well, you made 3%, so you're good. Does that sound like you lost money? Sure sounds like I lost money. If I was up 30% and now I lost all of that and I'm back down to 3, that sounds like I lost money. So that's what they guarantee. Their guarantee is that you don't make 3% every year. The guarantee is over the life of policy, you make at least the guarantee. And the guarantee is usually less than what you get buying treasuries. And the guarantee doesn't protect all of your money. It only protects a portion of your money. And some of them say, hey, you don't get anything if you don't hold it at maturity, so you lose your guarantee if you surrender early, which is what most people do once they figure out what these products are. So there are some guarantees, but boy, they're not all that particularly good. All right, so a lot of them, what they do is they're tied to stock index. The one I saw was tied to the S&P 500 and the Dow Jones for some reason, just to add more complexity to it. I guess that's good. The Dow Jones hit a record yesterday. I don't know if it made it today. I guess that's good. The Dow Jones is a really bizarre index, but what they say is you can get paid based on the index. And notice what the index is. It's the price index, which means it doesn't pay dividends. We'll talk about that. Dividends are a huge part of returns on stocks, so it only pays you the price index. So it's not a total return. So if the stock market's up 12%, but only up 9% in price, you're only going to be tied to that 9%. You're not getting the 3% in dividends. So it does not include dividends. Exclusion of dividends causes changes in S&P level use in equity annuities to significantly understate what you could have gotten in the market. Dividends have historically accounted for 20% of returns. You might say, well, it's only 20%, but it's that 20% of returns compounded over time that becomes a massive number. You'll see it in the charts, becomes a massive number. All right, the participation rate is the fraction of the change in a stock index credited to the investor. This sounds really, really good. So which would you rather have? One product, it's 100%. Another one is 50%. Which would you rather have? Doesn't 100 sound good? So let's see if 100 is all that good. One does it endpoint, 50%. One does monthly average, 100%. All right. So let's do the starting point. Month 1 all the way down through month 12. Let's say you start off at 1,000 and it rises 1% a month. So here the change is 12% and you get a 50% participation. So you're up 6.3%. That sounds pretty good, doesn't it? The monthly average, they take the average of the months, take that divided by beginning value minus 1, and you get 100% of that. Which would you rather have? 100% participation or 50% participation? Here's 50%. Here's 100. How can you possibly do better with the 50% participation? Because they're doing end-to-end point. Firms that do 100% participation, they're actually averaging, and if the markets go up over time, the average is going to be lower because you have all those points in between. Do you think the person sitting there listening to the salesperson understands that? Probably not. All right. But guess what the salesperson does? Oh, our participation rate's 100%. You can bet they sell it. They sell it hard. But that's one thing that makes these products, say, hey, our participation rate's 100%. You can see the other product you're looking at, it's only 50%. Participation rates vary significantly and be applied to different measures of index level changes. This is the part, I remember looking at this one product. You read those paragraphs. I like to say to people, hey, come here. You just bought this product. Tell me what this paragraph says. And they're kind of like, a little sheepish, like, yeah, I'm not real sure what that means. I think that means they pay me something or something. So they're easy to compare, but they're misleading. The higher participation rate does not mean higher payouts to investors. Right? I just showed you that, right? Whether you do monthly or point to point, it has a huge difference on what your actually return is. So the point to point, the one I just showed you, sometimes the point to points are regular intervals, an anniversary date. More complicated, the monthly average calculates the increase index from the start of each year to the average month end during the year. So it's going to give you the lower number just on average. As you can see there, it cut it more than in half. So, I mean, it had a pretty dramatic impact. Insurance companies can offer higher participant rates on annuities with monthly averaging because monthly averaging understates the increase in leveled index. The expected index change with monthly will be roughly half the expected with point to point. Thus, under the monthly averaging method, insurance companies can claim 100 when they're really only 50. So he has some good charts in here. So here's the S&P 500 with dividends. I think he started with $100. You would have had 4,900. If you take dividends out, which they do, you drop to 1,700. See how that 20% is really a lot more than 20% because you're compounding. If you lose that extra, if you're making 7% instead of 9%, that difference is huge over that many years. And here's what happens when you do without dividends and monthly. Does this look like this? This is like 100% participation. Anybody? You're expecting $4,900 and instead you have $544. Does that look like 100% participation? Looks like 10% participation to me, but or 15. As you can see, excluding dividends reduces return by 64%. The lowest line shows the value of index calculated monthly. Monthly averaging reduces the change by 70%. So it's huge. And these products often can go 30 years. So unsophisticated investors might believe they'll get 100% increase when in fact they only get 23%. Here's one with a shorter period of time. So the compounding is not quite so dramatic, but it's still, the difference is still quite significant. This is over 10 years. You can see it's less than half. The dividends aren't quite as dramatic. So you really need 30 years for that compounding to really take a huge impact. Over 10 years, it's significant, but it's not as significant. But whether you're doing 10 or 30 years, it makes a big difference taking out the dividends and doing monthly averaging. So sometimes they have a spread, which is not all companies, but they might say, okay, your index is 6%, but we got to take 2% off of that for expenses or whatever. So they're going to reduce it even more. Can be as great 3%, but two contracts linked to the same index with the same method can have different returns because they may be charging fees. Some firms do caps. Caps are destructive because the S&P, if it's up 10% over several years, there's almost no years where it makes 10%. It's up 30%, up 20%, down 10%, down 15%. If you cap it at 10, you're losing those 30% years, which is death to your return. The effect of annual caps is dramatic because the average long-term return on stocks is heavily influenced by those high returns. An annualized price appreciation was 10%. If we cap the increase at 14, the appreciation drops to 5.5. So saying, hey, we'll pay the 100% of the S&P 500, but we're going to cap it at 14%. You've now cut that return another 50% almost. Are y'all loving this product yet? Anybody want to argue for it yet? These annuities are touted as excellent investments for investors wanting to participate in market returns without bearing the risk. So let's say, hey, what if instead of buying this product, you just put your money in the S&P 500 and Treasury securities? So that's what they're going to do. So they put 60,000 in Treasury, so it's a pretty conservative portfolio, and 40,000 into an index fund. And they're compared to this equity-linked product, which sounds like 100% in the market, stock market. And they're going to compare those two. And here it is. You can put this in your ethics question. So remember on the end, I talked about stochastic dominance. This is the stochastic dominance. And remember, about 80% of class gets no credit for that. So this is your chance to be taking good notes and get your credit on that. What a stochastic dominance means, they ran many, many scenarios. I don't know how many scenarios they ran. They'll tell you in here somewhere. And they plotted it out. And equity annuities didn't lose 100% of the time, but they lost such a high percentage of the time that they lost stochastically. They were stochastically dominated by their simpler product. How often they lose? They lost 96.9% of the time. 96.9% of the time. So after 10 years, the expected value of the simpler product was $220,000. The equity annuities were $186,000. That difference, if you look at all the scenarios, when the equity linked annuity won, it gave you an extra $200. And when it didn't, it was off by $33,650. So even when it won, it didn't win by much. But that makes equity linked annuities look too good because there's some other problems. So he says, even this is overly generous because we assume that the contract is held to maturity. Most people don't, right? Because it's such a horrible product. They're like, wait, the market was up 20% this year and I only got 5% off that. What's going on? So it's such a bad product to get out of it. That's what the lady who called me, it's like, Ron, this product makes sense. That the stock market's up a bunch and I hardly made anything. And yeah, that's the product. That's the product. I wish you called me before you bought it. Disadvantage tax treatment, the returns earned on equity annuities are taxed at the investor's marginal tax rate versus, capital tax gain. That's not as big of a deal as it has been. There's an interesting fee and expense twist. Equity annuities do not have explicit annual fees or expense ratios, although some do charge that spread. The insurance company makes money by giving them less than what they're actually earning. Equity annuities are complicated investments sold to unsophisticated investors without the regulatory safeguards afforded to purchases. And one thing I missed in his notes, if you give them $250,000, all of these indices may not apply to the $250,000. They may actually apply to a smaller number. So you're even doing worse than that. In this last sentence, you could quote in your ethics paper, no registered rep, insurance broker, or retail investor, or precious few PhDs in finance or mathematics could understand these products. The net result is a complex formulas, hidden costs, is they survive as the most, and I agree with this, the most confiscatory investments sold to retail investors. Right, again, I hope I haven't stepped on anyone's toes. Any of y'all sell these, you can argue for it. You may not want to argue for it right now, but let me know you want to argue for it and we'll sit down and work it out. So y'all really wish that guy from my class was in here, but then he's getting a grade from me, so he may not want to take me on too much. We'll see some of this in health insurance as well. There's some really bizarre activity. It's funny, in my health insurance class a few years ago, I had a health administrator and a doctor come speak to the class. And the health administrator was just talking about how unethical hospitals and doctors are. And he was like apologizing to the doctor. And he's like, oh, that's fine. And then the doctor started talking, and he's even worse. He was telling us things that anesthesiologists do. And I'm like, I can't believe I didn't have it recorded. He wouldn't let me record that class, but he was like, no, we're as bad as he said ×2. It's really bad. So there's some pretty unethical things going on in this industry. If you work in this industry, there are some really good companies. You got to find those good companies, but just be aware. So if I know an insurance company sells these products, it just makes me leery of the company just because I just don't like these products. At one point, USAA was going to start offering these products. And I told them, if you sell this, I'm quitting. But I was going to quit anyway because I was ready to retire. But they didn't do it mainly because they have had really bad success selling products this complicated. because they're direct writers. They don't have sales agents. It's really, really tough. They've done, I think I told you they did variable life and they had to shut it down. They just could not sell it. So this product would have never worked. The actuary's argument was, yeah, it's a horrible product, but our product won't be as bad as everybody else's. It's like, that's not a convincing. They didn't say it would be good. They just said it wouldn't be as bad as the others. Why were they arguing they need this? Because that's what's selling. Like, we're losing customers to these other insurance companies because this is what they're selling. So they were thinking, we got to sell this product. So I understand that, it's hard to see all this money going to other companies. Comments, questions on this? So you can copy and paste some of this into your ethics question, especially on the stochastic dominance, on the complexity. This is like the perfect example. I like to say poster child, but I have some students that know what poster child is. Y'all know what that is? This is the poster child for insurance complexity. So it's the perfect example of that. I can't think of a more complicated product than this. I hope I never can think of a more complicated product than this. I would ask my friend if she would send me her contract, but I don't want to embarrass her that I'm showing my class what a bad mistake she made. But you would be shocked at the language in these contracts. They're very, very hard to understand for anybody. It's really complicated language.
So are there like any like credentials or like certifications that these salespeople have to get, or anyone?
Well, they have to get licensed by the state for insurance because it is an insurance product, but they don't have to be licensed by the SEC.
Like the actual sales?
Yeah, people who sell, they sell life insurance. Yeah, a lot of wealth managers hate these products, but some of them do use these products. They're tempting because the commissions are so high. So it's hard not to get enamored by them. All right, other comments, questions? I don't even know if the link still works. It is an old article, but I can't find a more recent one that is this thorough. I wish they would revise it, but it is out there on Canvas. Everybody understand this? Point to point, monthly average. You just know the sales rep only says 100% participation. It doesn't go into any more detail than that. And remember, when people are selling these products, it's not like they have a regulator sitting there and listening to them. They're in people's living rooms. They're saying whatever they want to say. So there's not a lot of scrutiny. Their insurance companies aren't monitoring them. So, there's no telling what these people are saying in real life. All right, so get your calculators out. We're going to do an equilinked annuity. This is the only math problem on the exam. Everybody better make 100% on this. If you miss it, I'll call you at 2 a.m. that night. Ask what was the problem, because it's very straightforward. If you took my P&C class when we did the catastrophe bonds, there's some similar math here as well. This is a very common approach. I love this concept of this product. I'd love to sell a product like this. I try to sell a product like this at USAA, but without all the costs. A product that would actually send all the benefit to the customer. But my boss said, yeah, let's do it. And he wanted to charge 1% fee. And I thought, that's crazy. That's too much. But I love it. There's a YouTube that walks you through this, and we'll do some more in class. We'll do some more examples on Thursday. But this is our first time through. So this time what you want to do is just really paying attention to the math. What we'll do probably Thursday and Tuesday, maybe on Tuesday, I'll give you the math problem this weekend. I'll give you the exact problem from last year's exam. So you can see exactly how it's formatted, let you work it, and then we'll do it on Tuesday so you can get perfect practice. The challenge is the exam's quite a ways away, so you're going to have to go back and rework it again. So this is a product, comes in with a premium of $200,000. I'm ignoring all the things they take off the top of that. We're going to invest all of that. Remember, the insurance company is going to send 20,000 of that to the commission, to the agent. So I'm assuming there's no commissions. This whole thing's all our money. It's got a guaranteed minimum crediting rate. That's not every year, though. That's over the life of the policy. That's why you can say you can lose money on these products, because the market's going to go up and down. All they're going to do is make sure you make 1.5% over the years. It's an 8-year product, which can be really important to us. I'm kind of making that up. I mean, they don't have to have, they'd probably be longer than that. And here I got to give you something, man, this is an old product because the S&P is over 5,000 today. So we got to talk a little bit about options because that's essentially what this product is. It's a bond plus a call option. It's essentially what this is. So let's say the S&P is at 1450. So boy, that must have been like, oh, how many years ago? This has been in my notes forever. Anybody know what an at the money S&P index call option is? What's the strike price for this? 1450. So if it's at the money, that means the strike price is the same as the current level of the S&P 500, right? That's going to be critical for your understanding this product. So as a strike price, what does a strike price mean? So a call option is what? The right to buy something in the future at the strike price. So if the S&P goes to 2000, you have the right to buy the S&P for 1450, and you could turn it right around and sell it for 2000 and make 550 bucks. All right, that's how a call option works. What if the S&P falls to 1000? What would you do? Nothing, just let it expire worthless. So you don't have the obligation, you have the right. If you do futures, you have the obligation. All right, but with options, you have the right to buy something at that 1450. Y'all see why it's 1450, right? It's at the money. So whatever I say the current level of S&P is, that's what the strike price is. The strike price just means that's the price you get to buy this at anytime in the future over the next 8 years. So if the S&P goes to 3,000 or 5,000 or 10,000, whatever, you get to buy for 1450. My best example is GameStop. I might show the investment class GameStop. If you bought a call option on GameStop when it went from 20 to 400, you would have been smiling pretty good. Smiling better than an equity links annuity salesperson. You would have been pretty happy. You would have made a massive, the percentage gain is almost incalculable. All right, so that's what a call option is. So to get this call option, you have to pay $500. All right, so the S&P goes to 1600. You don't make 100, you make 150 bucks on the option, but it costs you 500 bucks. You'd actually lose 350 bucks. Why is the premium so high? Because this is 8 years. This is a very, very long-term option. The S&P goes to 3450. You make $2,000 on the option, but it costs you 500 bucks, so you'll just net 1,500. Okay. And if you're buy a bond, an 8-year, I'm making it a little bit simpler. Insurance companies don't actually do this, but to keep the mathematics simple, we're going to do an 8-year zero coupon bond paying 4.5%. You'll see why it just makes the math a lot easier. Right. So this is really key. Those that, I forget who did cat bonds last semester. No, Gracie. Can't remember who else was in there. What was anyone else in there? Gracie, you're the only one. Okay, well, Gracie might recognize this. So we got a huge advantage. So Gracie on the cat bonds, the cat bonds were paying 5%, but we were only making 3%. Here, we're paying 1.5%, but we can make 4.5%. And that's the key to this product and what I love about this product. You want to create a minimum guaranteed return product. This is how you do it. So we got to pay these people 1.5% over the next 8 years, but we can make 4.5% on bonds. So the first question is, how much should the insurance company buy of this zero coupon bond to make sure they have enough money in 8 years to pay 1.5%? Okay. So we were talking about the FAC exam earlier. Y'all remember the FAC exam? How much will they need in 8 years to defease that guarantee? And Bill Gates doesn't know the word defease, but that's how I spell it. So they started with 200,000 bucks, and you're going to pay them 1.5% for 8 years. So at the end of 8 years, you need 225,298.52. Any questions on that? Make sure you do it in your calculator that you know how to do. I have students that have to borrow a calculator and like, how do I do the exponent key? And I don't know any better than you. Just look for the X of Y or Y sub X and hit some buttons until you get something. I would recommend you practice this on a calculator because this is in class on a calculator, not on Excel. You practice it on your calculator and use the same calculator in the exam that you practice on. All right, so 200,000 times 1.015 to the 8th power. On the exam, you can round it to the nearest dollar. I don't really need you to go out pennies. I think I do it on pennies in here, but I can't remember. All right, that's what they need in 8 years. That's not the answer to the question, because they're not asking what do you need in 8 years. They're asking how much do you need to buy the bond today so that you have that in 8 years. So look at step 2. In 8 years, you need 225, 298, 52, but you're going to invest at 4.5%. So now you see here we multiplied. Now we're going to divide. This was a future value. Now we're going to do a present value. All right. So we need 225, 298, but we're going to invest at 4.5%. So all we need today is 158,426.57, and that is the answer to the question. They need to put 158,426 into this bond, earning 4.5%. If they do that, they've got everything they need to meet that 1.5% guarantee. All right, there's questions on question A. We'll do another one of these Thursdays and then one more on Tuesday. I'll kind of, my theory of retention is quizzing and separation. In fact, when we do it on Tuesday, one of y'all might want to volunteer to work the problem for us without any notes up here. I'd love to see that. That'd be great. So no questions on this. That is the answer. Right. The second question is, how many of these call options are you going to buy? Well, some people get really confused here. The number here is the 200,000. Don't use that 225. Today, someone walks in with 200,000 bucks. They give you 200,000 bucks. You're going to immediately buy bonds worth 158,000. So how much money you have left over? They gave you 200,000. You've spent 158 on bonds. You have 41,000 left over. And this is the trick. I mean, let this sink in. This is an incredible product. If it just wasn't such a disaster coming from life insurance, it's an incredible product. What does this mean? If you want to guarantee a 1.5% return over the next 8 years, you do this, and then the money you have left over, you can do whatever you want to. So what's the worst you're going to do in the next 8 years? 1.5%. You could go to Vegas with that 41,000. You could put it all in one stock if you wanted to. What are we going to do with it? We're going to buy call options in the S&P 500. The market goes up, we make money. If it goes down, what do we get? We're going to make 1.5%. All right, see how this thing works. It's a wonderful product, makes a lot of sense. It's not the product they compared to, and I wish they would have compared this product to what the equity-linked annuity does. But this is essentially what the life insurance company is doing. So we're going to spend 41,000. Each option costs 500 bucks. So we're going to buy 83 options. Now, some of you are thinking, well, don't you have to buy 100 of them? But ignore, if some of y'all know option contracts, and option contract is 100 options, ignore that, all right? Because this is an insurance company. You got thousands of customers, they can handle that. So they won't buy exactly 83, they have to buy 100, but they've got 20 other customers. So ignore the times 100, all right? If you're used to that, just ignore it. If you're not aware of that, then just completely ignore what I said. All right, they're going to buy 83 options. Here's a rounding, really, I don't care. So I don't know if it rounds up or down, I can't remember. Yeah, it's 83.1. I don't care if you use 83, 84, but I would round down if I were you. Just you'll see why when we do the table. It shouldn't be an issue, but just to play it safe. I made a mistake at USA when I was doing options because I had a strict compliance and I rounded up once and I bought like one extra no big deal. And my compliance officer, I had to write a letter to the USAA board explaining why I bought one extra option. So rounding down is probably the safer thing to do. Any questions on that? So what do we do in problem one? We took their premium times 1 plus guarantee times the years. And then we took that number and divided by 1 plus what they can earn on the bonds to the time. We then took that amount subtracted from the initial premium. You divide that by the number of contracts. All right, everything in blue and yellow you have to figure out. And I don't give you formula sheets or anything like that. Formula sheets don't make sense if you're a finance or actuary major. Trust me, if you have a professor who gives you formula sheets, you should complain. You should never use formula sheets. So a formula sheet is like walking into a doctor's office with a pain in the side and a doctor pulls out an anatomy book to figure out which side your appendix is on. Your next step is what? To leave the office. So if you have to look up formulas, you're not a finance major, you're not an actuarial science major. You should know these formulas. This is our anatomy. So just learn them. This is pretty straightforward stuff, present value, future value stuff. All right, and then the next thing you do, second to last thing you do is you fill out this table. All right, I've got it filled out here. The first column is really, really simple. How much is that bond portfolio going to be worth in 8 years? We already calculated that. It's that 200,000 times 1.05 to the eighth. You can calculate it again if you want to, or just bring the amount down. And again, if you want to, you can round it to the nearest dollar. I don't really care about that. All right, so the ending value of your bond portfolio, we're doing this from the insurance company standpoint. The ending value of the call option. All right, if the S&P falls, the option is worth nothing. The S&P doesn't move at all, the option is worth nothing. The S&P goes up, then here's the formula for a gain on a call option. So if you're in my investment class, you're going to see this like 20 times on the final exam. So the gain on the option, call option, is the max of the stock minus the strike. So S is the ending value of the stock or market index. X is the strike price. Depends on whether you're a bowler or you play baseball. So if you're a bowler, X is a strike. If you're baseball, sometimes you'll see what? You'll see a K. So don't get confused. Some formulas use K. Just depends on what sport you're more accustomed to. So in this last case, we'll look at it. The first case, 870, the max of 870 minus 1400 and 0 is 0. So that equals 0. In the second case, the max of 1450 minus 1450 and 0 is 0. And in the last case, the 2850, you take 2850 minus 1450. That's greater than 0. That's 1400. You get 116,200. Questions on that? And this is out there on Canvas, so the formulas are out there. So you make 0, 0, 116. So what does the equity annuity have? What does the insurance company have to give them? Well, if the stock market doesn't go up, they're just gonna get that 1.5%. That's all they have left. And they'll be happy, especially here, they'll be happy, right? Because the S&P fell and they at least made 1.5%. If the market goes up, they end up with 341,498. All right. Then what you do is calculate returns. How do you calculate returns? Return, it's going to be ending value divided by beginning value. You get that value and raise it to the 1/8 or 1/n minus 1. If you don't know this formula, make sure you learn it because we use it a lot in finance. That's just you can call that your annual return. You can call it the CAGR, compound annual growth rate, but it's just ending over beginning, raised to the 1/time minus 1. That's your return. For the first two, you don't need to calculate them. You could do that, but you better get the guaranteed minimum. you better get that 1.5%. So yeah, you can take 225, 298, divide it. Now your beginning value is the 200,000 that they invested. All right. So if you do 229, 298 over 200,000 raised to the 1/8 minus 1, you're going to get 1.5%. All right. And so on this here, we're going to take I guess I never wrote that one down. So here we're going to take 341, 498, 52 divided by 200 raised to 1 over 8 minus 1. And that should get you 6.92. Do practice it with your calculator. Make sure you're getting that. And in the last column, you do the same thing, but for the S&P 500. So on the first one, 870 is where it ended. It started at 1450. You do the same formula, 870. $870 divided by 1450 to the 1/8 minus 1. That's a loss of 6.19%. Here, if the market doesn't move, it's just a 0% return. And in here on the upside, 2850 divided by 1450 raised to the 1/8 minus 1. And that gives you 881. And one way you can tell if you got a problem is comparing the equity annuities return to the stock market. What you should find is it does better in the down market and does worse in the up market. If it did better in the down market and did better in the up market, you would never buy the stock market. But you're never going to find that. So options will never be priced in a way that you're going to win 100% of the time. That just makes it pretty easy what to do. So here you win 2 out of 3. You win here, and you lose there. I didn't graph it, so let me bring these numbers in. So that's the last question. You don't see it on this one, but I am going to ask you to graph it. So we got the equity-linked annuity, we got the S&P. So 0.015. The S&P. If we graph these, you'll get a it doesn't quite work out because I couldn't get the math exactly right. I want to make it more symmetrical. But what you get is an equity annuity. You get your floor, and you get the upside. What does that look like? It looks like a call option. It's like a call option. The difference is we're creating a minimum that's a positive. With the call option, you're out to $500, but the market goes up, you gain. But because we're combining a call option with a bond, we're getting that 1.5% floor, and then we're getting the upside from the call option. All right. So this, hopefully, if you've had options before, some of y'all see it in my investment class. I think Rob might be the only one in my investment. Diego might be in there. So a couple of you might be in my investment class. Some of you have taken my Dan, you're in my investment class. A few of you are in there. See how Diego, you're in that class? Yeah. So y'all see this later, but call options have this kind of hockey stick kind of design to it. Equity annuities are essentially that same product. This should be a straight line, but I just couldn't get with the rounding and everything. I couldn't get it exactly parallel. So the stock market is just a straight line, but an equity annuity does this. You are losing money on the call option, but it's offset by that bond that you purchased. I think this is actually a really good payout for a lot of people, especially people that are retired that can't take the downside. Back in 2020, when interest rates were like 0.5%, I think this type of payout could be a pretty decent payout. Give you some protection. So I'm not saying I don't like this product. I think it makes a lot of sense, not for young people, but for older people. This protection makes sense. If someone would create this product without all the excessive fees and commissions and all that, I think it could be a really good product. This is the product we try to create at USAA in a mutual fund, but the lawyers just would not let us. We couldn't get around all the regulations. All right. So that's the equity annuity. We'll work on another one Thursday, and then I'll send you one by Canvas to work next Tuesday. So you'll have 3 of them. The 3 we work, the one we'll do Thursday will be different than the example problem. So we'll work some so you get more on YouTube, so you have more examples to watch. All right, so I don't want to start anything new. We'll do this again. Remember, Thursday we have a guest speaker. Some of y'all are on your phones during class. It irritates me, but don't do it when we have a guest speaker. You can irritate me, but don't irritate a guest speaker. Please just turn your phones off. We put them away because it's distracting to them, especially a guest speaker who wants to give you $5,000. You know, give them some attention. All right, that's it. So now we have a guest speaker to talk about a scholarship that the Insurance Council of Texas has. This is Richard. He's been here a few times before. He comes in this fall, but his focus is on the spring when you P&C insurance, but some of you have seen the P&C or might take that class next semester. One more time, how many are actuaries? So Jackson, Gracie, Jessica, Yin Win is too. She'll probably be here pretty soon. So we got a few actuaries in here. So, Richard's going to talk about the scholarship. If you have questions, let them know. And also come to me and I can definitely help you get everything set up and ready to go. So, all right, Richard, thanks for coming.
Yeah, thanks for having me. Like you said, I'm Rich Johnson. I'm the Director of Communications and Public Affairs for the Insurance Council of Texas. And you guys are like, what the heck is the Insurance Council of Texas? Can't tell you. There we go. So what we are is we're the state trade organization for the property and casualty insurance companies. So if you think of USAA, State Farm, Geico, Nationwide, we represent all those companies with the state. So we have about 400 member companies, and all of our member companies represent about 86% of the P&C market in Texas. So, and so what we do is we represent them in front of the legislature, in front of the Texas Department of Insurance, who regulates insurance here in Texas, as well as media. We do some public safety campaigns, some public awareness campaigns, that type of thing. We try to just educate people on insurance and kind of, like I said, represent the insurance industry in Texas. I want to talk a little bit about the job market. I'll be real fast. I know you guys have other things to do, but right now is a really, really good time to get into insurance. The property and casualty insurance industry is old. Everybody's getting older. All the older Gen Xers and the baby boomers, they're retiring. And over the next 5 to 10 years, they say as much as 50% of the property and casualty insurance industry is actually going to retire. So this is a really, really good opportunity to get in, especially if you're learning insurance. If you talk to people who are in insurance now and who've been there for 20, 30 years, a lot of them just kind of fell into it. Oh, I needed a job after college. I didn't know what to do, or I was getting out of the Army and I needed to make money. But what you guys are doing, you have a really good opportunity that you're learning the business and you're learning the language and you're learning insurance now. And so you're going to have a leg up on that generation before. So you're going to get in at a much more interesting level. You'll probably be promoted faster than other generations. You'll probably make more money than other generations. And it's just a really good time because, and in addition to that, the industry is changing. It's switching, just the innovation and the technology that is going into insurance right now is just, it's phenomenal. It's unbelievable, just between app development, what's going on with AI, what's going on with machine learning, all the different technology and innovation that's going into insurance right now. It's not just sales. It's not just working for an agency. There's just so much to do right now when it comes to underwriting, when it comes to claims, when it comes to actuary, when it comes to legal and regulatory and legislative environment. There's just a lot of opportunity for you guys going in there. There's about almost 300,000, about 280,000 people that work in insurance in the state of Texas, which is a lot. We're the second largest insurance market in the country behind California. And unemployment right now is actually really low for insurance. And if you go and you search around the world, there's about 400,000 jobs that are open right now in insurance. So there are jobs available. Like I said, we're the second largest P&C market in the country behind California. If we were a country, we would be the seventh largest country when it comes to insurance. So it's just a massive business with $75 billion in premiums that are paid every year. The largest of which we'll get to, but the largest of which is auto. And something to think about when it comes to an insurance and the importance to the state is we're the fifth largest revenue source. So all the taxes, when you think of property taxes, sales taxes, any kind of fees on your cars, the premium taxes that insurance companies pay makes it the fifth largest revenue source for the state, bringing in about $4 billion a year into the state coffers. So it's a really important business when it comes to state and income or the state revenue. We'll go through this real quick. There's about 54 million P&C policy in the state. That includes passenger auto, your home insurance, commercial insurance, and the largest of that is private auto with about 30 million policies and almost $32 billion in premiums just for that alone. So again, big business. One of the big issues that we're dealing with now, who pays their own car insurance or has renter's insurance or home insurance? Yeah, has it gone up recently? Yeah. It's because of losses. Texas is dealing with a lot of losses over the last couple of years. When we had the pandemic in 2020, we were like, yay, nobody's driving. We should be lowering rates, and everybody gave rebates. But what we did was we picked up really bad habits. We started driving faster. We were driving more distracted. Everybody, not only is it your phone, it's now a screen. And impaired driving has picked up. Drunk driving, high driving, distracted driving, all those things. We picked up really bad driving habits. And so accidents have actually gotten worse. The frequency and severity of accidents has gone up, as well as inflation. The economy, the cost to repair and replace vehicles, the cost to repair and replace homes, all of those things have skyrocketed over the last couple of years. So therefore, your insurance rates are going up. On top of the losses, Texas is number 3 or 5. We're in the top 5 for everything from hail, wind, hurricanes, floods. We now have earthquakes. We now have winter freezes. So far, the only thing that we haven't had is volcanoes. But you know, it's Texas. We're going to try to claim that one probably eventually. Yeah, it's getting, you know, just the if you read a lot of the stories that are out there about insurance, it's all about rates, it's all about availability, and companies changing their policies, whether it's deductibles or whether it's where they're providing insurance. Anything about jobs or kind of the market or anything like that? Any questions? All right, cool. Then we'll talk about what you guys really want to know about is free money. Oh yeah.
So about the only P&C company that we know comes to UTSA is USAA.
Oh, okay.
How do they apply to State Farm, Allstate, and the others?
Yeah, so all those companies are looking for talent right now. They're looking for young talent. Get on LinkedIn right now. Start looking for people. Start looking, you know, do the search for the jobs. Search for people that are doing the jobs that you want to do in a couple of years. Start networking with them. Hook up with them on LinkedIn, whether it's USA, State Farm. There's a company, UFG, Berkeley Southwest, Chubb. There are so many companies that have a presence in Texas. And that doesn't mean that you need to stay in Texas because they all have offices everywhere else too. But Texas, like I said, is the second largest market. So all the big companies have, you know, whether it's Dallas or Frisco or Houston or here in San Antonio or Austin, there is some sort of presence throughout Texas. There's some really good companies in, I forget where Germania is. Yoakum? Yeah, there's Germania, there's Hoheim Prairie, there's Texas Farm Bureau up in Waco. So there's kind of some medium-sized businesses also that are just in Texas, that are really good career opportunities as well. And people at those kind of companies stay a long time. And not to say that people don't stay at USA or State Farm. You know, State Farm has a huge presence up in the Dallas area, and are often looking for everything from actuaries to IT, underwriting. There's just really good opportunity, and not only do you have to, you know, a lot of these companies also have remote or hybrid opportunities as well. You know, where you're not going into an office 5 days a week. So yeah, but just check out their websites. Internships are huge to get. They're all paid for the most part. So check the companies, reach out to the recruiters regarding internships. There's also an organization that has really good internship opportunities called WISA, WISA, I think it's called. And not only do they pay you for your time, but they pay you for your housing, they pay your transportation. I talked to several students where they had a rental car for like 3 months during the summer, and they split their time between Chicago and Zurich because they worked for Zurich. There was people that I knew that went to New York, that went to Boston. There was a couple that stayed here in Texas, Minnesota. There are a lot of really good internship opportunities out there in the insurance industry that are paid. And a lot of those, in fact, most of them, those companies are looking to convert their interns into full-time positions. So it's just a really great time right now to look at the PNC industry when it comes to careers. Anything else about jobs or careers? All right. So part of ICT is we also have a foundation. We've started giving scholarships and funding to programs back in 2002, and scholarships go directly to students. And then we also do what we call academic achievement funding, where we award funding to the programs where we work with the professors, and that funding goes towards, you know, maybe it's travel expenses to a conference. Hopefully, we would love you guys to come to our conference. We invite about 20 to 30 students a year to come to our conference every year. Next year, it's not going to be in the summer next year. It's going to be, it's going to be this week, actually, a year from this week, in Austin. So we pay for hotel, we pay for some travel expenses. Of course, you get fed while you're there, but really, really good networking opportunity to meet with professionals that are, you know, in the Texas market with all the big companies. They're all our members, and they're always enthusiastic to see students come in. We usually have some planned events, whether it's kind of a job fair or speed interviews for students, or just programming that is centered around students. That's just kind of career advice, getting your resume in order, how to create your personal brand, how to be a leader, that type of thing. So since 2007, we've given away $1.5 million in scholarships to 720 students. And to UTSA students alone, we've given away 75 scholarships and over almost $17,000 since 2007. So we're hoping to increase that this year. So hopefully you guys apply. And here's the information. Go ahead and scan that. That takes you directly to the application. If this application takes you 30 minutes, you're doing something wrong. It should take you 20 minutes probably. It is personal information. It's the school you go to, the classes that you're taking. You know, hopefully you're taking insurance classes. Talk about how you're taking this class. Talk about how you're going to take the PNC class in the spring. Are you involved in, do you guys have GIS here? No. Okay. Talk about the business organizations that you belong to. Are you a leader in you know, whatever it might be, you know, whatever organizations you belong to. Talk about your leadership and your passion or your interest in the insurance industry. If you go in there and you start talking about how you want to be a banker or an investment banker, probably not the best scholarship to apply to, or you know, you want to be a concert pianist, that's probably not going to help you out. This is not something that's GPA focused either. It is something that we score on, but it is not all the 4.0s and the 3.8s that are getting these scholarships. You know, so don't, you know, if you don't have, you know, the best, greatest GPA, don't worry about that. because it's really about your interest in the industry and the classes that you're taking and the initiative that you're showing to further yourself in the insurance industry. Deadline is October 11th. So something really important to keep in mind, because we are shutting it down at midnight. And we're going to do a really fast review. We're hoping to have checks in hand before before the Thanksgiving break. We're shooting for like November 11th. So it's going to be a really quick turnaround time. The money goes directly to you. It does not go through financial aid. It does not go through the school. It is a check that is mailed to you. So you can use it for whatever you need to use it for. If that's books and tuition, great. If that's whatever you need to do on the weekends, that's totally up to you. If it doesn't go to your parents' house, that's up to you as well. Depends on what address you give us. But in reality, it's a really great opportunity. We're giving away 40 scholarships. And we only have 9 schools that we work with. We have 9 schools that we work with. It's not a statewide thing. There's 9 specific schools. I'm coming to classes just like this. It is for students just like all of you. 40 scholarships, giving away $75,000. We're giving away 5 $5,000 scholarships, 10 $2,500 scholarships, and 25 $1,000 scholarships. So out of those 40, last year we had 100 applications. We gave away 40 scholarships. So the odds are 60-40, I guess, 40% chance that you're going to get a scholarship. But if you put in a good application and you show a real interest in insurance, then you have a good shot. So please apply by October 11th. Any questions about the scholarship or anything like that? It's pretty simple. There's a written statement of interest. That's just to kind of tell your story of why you're interested in insurance. You can upload a resume and any kind of cover letter, or if you want to, kind of expand on your story a little bit. But it's a pretty simple application to fill out. So nothing. All right. It's free money. So fly away. That's all I got.
Thanks, Richard. Pull it out. Yeah. Okay. I think so. I probably gave you their message. All right. Thanks for.
All right. Cool. Thank you very much. Appreciate it. Good luck, everybody.
All right, we do. So please definitely apply, and then I'd recommend you set up time with me. He says it's a quick application, but the story is the most important thing, and you really want to emphasize, like if you're an actuary major in your actuarial club, that helps a lot. Anything they see actuary, that's like such a close tie to this industry, that helps a lot. If you're not sure you want to work in this industry, you can certainly emphasize that, and saying, I don't know what I work, this is as good as any other. You can certainly strengthen that to a much better statement than that. And I can give you some words that would certainly help with that. So any of y'all think you will apply? We have some in here. Yeah. All right. Hopefully more than that. So I'll send these to you this weekend, and then on Tuesday, we're going to work the problem from last year's exam, the exact problem. And yours will look very much, that's why everybody should make 100 on this. The essay question is a little squirrely. So let's work the second one. The one we did last week, I can't remember. Let's make sure we don't work that one again. So 200,000 and 150. So I'll do this one, 400,000. So before we do that, let's think steps. What you're going to do. So I like this problem first, learning equal-linked annuities, that it's something you can create yourself. You don't need, there's nothing magical life insurance companies are doing. Or you're just using things in the capital markets to create cash flows that look interesting, and it's a great product. So it introduces you to the equal-linked annuity, but also there's a lot of math here that is actually useful for other finance applications. And so the first step you got to do is you got to calculate the guarantee. Does anybody remember the formula for that? No formula sheets on this. Any takers on that? Yeah, remember? So they come in with $400,000 and we guarantee them 1.5% for 10 years. What's the formula for that?
400,000 one plus the rate. Rates for the.
To the end, yeah. Just make sure you have the parentheses in there. Be real careful with your calculator. Test it, make sure you're getting the right answers and test it with your calculator over and over again. So you make sure you don't have any exam anxiety, especially things like decimal points and those kind of things. Make sure you have that. Right. In step 2, you need to calculate the amount, the bond by day. Any takers on that one? So this is a future value. What's this one here? The present value. So what's that formula going to be? So you took $400,000, you invest it at 1.5% for 10 years, and you get some guaranteed amount. So what's the present value going to be?
You're guaranteed divided by 1.8.
What else? Raise to the end. So here is the guarantee rate. This is the coupon rate or the yield, the bond yield. I guess I'll say the bond yield. So you've got to get that because that's going to set up that floor. And you can do this with your own money. It sets up a pretty interesting floor, and then it gives you something to play with. All right, step 3. Determine how many options are purchased. Maybe that's even should do a step before that. How much money do you have? Buy options. Well, I'll make it an extra step. So how much can you buy options with? So you've got 3 numbers right now. You got the premium, you got the guaranteed future value, and you got the present value to invest in the bond. So how much can you buy the option with? Only 2 of those numbers are today's dollars, and one of them is a future dollar. So you obviously can't do anything today with a future dollar. So anybody want to try that one? Yeah, premium minus the present value, the bond. And in step 4, determine how many options purchase. That one's pretty straightforward. So it's the amount available divided by what? The option premium. It is interesting. Options use the word premium. Insurance uses the same term premium. Insurance is an option. There's a lot of similarities between insurance and actual options. Actuaries don't use option pricing models to calculate insurance, but they could. It would be possible. All right. So that's really what you're after. And then step 5 is complete the table. And then step 6 is draw the graph. And that's the problem always through. It should be very, very straightforward. So let's try this first one. So how much should the insurance company purchase in 0 coupon bonds today? I'm going to move this over to Excel just so I can have a little bit more room. Right. So the future value guarantee is going to be 400,000 times I use two parentheses, so test it on your, don't test it in Excel alone. Make sure you test it on your calculator. All right, do y'all have the calculator you're gonna use on the exam? I mean, you can type it like this in the calculator, but you can use parentheses, but I would test it. So 1 plus 0.015 raised to the 10. You can kind of guess what it's going to be. It's definitely going to be more than 400,000, probably less than 600,000. So you can kind of guess what it's going to be. That's the number I get. Someone else confirm it though. You have plenty of time on the exam because the only thing we do in the exam night is this math problem. You have the entire 75 minutes. It shouldn't take you that long. So you have plenty of time. But what you don't want to do is come in here and you forget something. You're going to try to spend 40 minutes reconstructing the whole problem. So you want to, it'll just fly through. It should be just second nature. You have plenty of practice problems. Anybody confirm that number? Yeah. All right. So now we'll do the present value for the bond. 464216. If you want to leave off pennies, that's perfectly fine. Once you get past the first one, divided by 1 plus 0.038. There's the bond rate right there, the 3.8%. Raised to the 10. You know you're gonna get something less than 400,000. So feel free to leave pennies off if you want to. It just makes the calculations faster and it'll be close enough. You may confirm that one, 319. This looks good. Okay. Amount available for options. So here we're going to take the 400,000 that they walk in with minus the 319,703 that we spent. So we have $80,000 to invest on these options. So you can do this yourself. You can't do this with futures. You have to be options because with futures, you can lose a lot of money, but it has to be something where you know the most you can lose is the option premium. If you wanted to set this up for your grandparents or whatever and say, hey, I can create something where the worst you'll do is make 1.5%. But again, it's 1.5% over the 10 years. Any given year, you're going to lose because you might go up, it comes down, you know, all these kind of things. So, all right. And then number of options. So here we're going to take 80,297 and divide it by the option premium, which here is $940. And here again, you can round. And actually, yeah, just round. Don't even truncate, just round. Ideally, truncation's better, but I don't care if you do that. If you get 85.6 and you want to round up to 86, that's fine. So just whatever the rounding is, take the decimals off. In reality, the insurance company can go out decimals because they have thousands of customers and they can get it to work out. So it's pretty close. So we don't have to get every individual contract to be perfect. We just have to get the entire group of products to be. All right, questions up to there?
Did you advise the number of options?
80,297. Look right. Y'all tell me if you're getting a different number. I sometimes do this in class and I make a math error. And after the class leaves, one student comes up, oh, you had a math error there. It's like, oh, that's good. Now every student has that math error. So speak up now, not when everybody's leaving the room. Everybody get 85? Look good. Okay. And now for the table. So we got the S&P, we got the bond, the option, and the equity annuity. So the S&P could have fallen to 975. It could be at the same level, 3,800, or it could have risen to 12,900. So those are the possibilities for the S&P 500. So how much is the bond going to be worth? Haven't we already calculated that? The future value, right? So the 464, 216, make sure you get the right number, but yeah. And that's going to be true all the way down. And for the option, the gain on option is going to equal the max of the current S&P minus the strike and 0, because you can't be negative. Now you might be thinking that in your investment class, you also subtracted the costs of the option. That's true, but we subtracted that when we bought the option. So it's really already out of our numbers because it's out of our future value. So it can get confusing. So my investment class, we take the gain on the option minus the option premium to get the gain on the option. But here we're just looking at what's the gain on the option before the premium, because the premium is taken care of in the fact that we only bought 316,000 or whatever worth of bonds. So here you got a max of 975 minus 3,800 and 0 times 85. And that should get you 0. The next one, you're going to do the max 3,800 minus 3,800 and 0 times 85. That's also going to give you 0. And the last one, the max 12,900 minus 3,800 and 0 times 85. Y'all give me a number before I hit enter. Make sure everybody's with me.
7,800.
Yep, that sounds good. And the equity annuity is it's just some of those two portfolios. It can be that way, with the insurance company, it's not quite that because they have all these fees and they have these caps and all these kind of things going on. But if you did this personally, this entire thing is fairly easy to set up except for the options. It's hard to find 10-year options. So you'd have to do a little bit different. There's some trading you have to do, makes this complicated because you actually have to roll the options in a way that you keep some of that value. But there are 3 and 4 year options you could buy, but the equity annuity is just the sum of those two. You just add across. I get 12 million, 1.2 million when the stock market's up, and then they get the minimum when it's down or flat.
Wait, how'd you get the 100?
We added across.
Oh,
And the reason I want you to do that is once you see the equity annuity is essentially a bond portfolio plus an option. You can't buy stocks and bonds because stocks can lose money. You have to have something where you know what your max loss is. So you have a floor. We need a floor on this. All right, so the ELA return. Here, what you're going to do, if you remember this formula, It's going to be ending divided by beginning, raised to the 1 over n minus 1. Very, very famous formula in finance. If you don't know this formula, it's the CAGR formula. It's the annualized return formula. It's a very, very popular formula. And you're annualizing the return by raising it to the 1 over n. If you don't do the 1 over n, you're just going to get how much did how much did $1 grow over 10 years. But we want to know an annualized number because that makes more sense to us. Now you already know the answer for these first two, don't you? What's that going to be? 1.5%. I mean, you can calculate if you want to, equal 464, 216. What was the beginning value? 400. We may not get exactly 1.5 because we're rounding. 1 divided by 10 is 1. Let's see how close it gets. So 1.5. And that's the exact same thing here. So those two are the same. You don't have to do that on exam. You can just put the minimum guarantee there. If it's the same S&P or lower, it's going to be 1.5%. Then here we'll do 12, 3, 7, 716 divided by 400. Raised to the 1 divided by 10. Minus 1. Y'all tell me before I hit enter. Oh, is it that high? Wow, it is. Okay. I don't remember doing one that high. This one go out 2 decimal places, especially since the 1.5 goes out. If I set up the problem correctly, the S&P return should be higher in that last scenario, but we'll see. So the S&P return is going to be the same thing. We can take that ending value to 975 divided by the beginning value, 3,800. Raised to the 1 divided by 10 minus 1. That gives us minus 12%. Here we'll do it. We don't really need to do it, but 3,800 divided by 3,800 raised to the 1 divided by 10 minus 1. That's just going to be 0%. Then here the interesting one, 12,900 divided by 3,800. Oops, the num-block key, and then everything goes away. $12,900 divided by 3,800 raised to 1 divided by 10 minus 1. And we know it could be right because it's higher than the equity-linked annuity. Anybody getting those numbers? Look right. No one's shaking their heads. All right, Sandy, I'll trust you. So there are some hints if you did something wrong that some of these numbers. What I'd say, let's say you have a math error and you get 14.3 there, and you don't have time to fix it. You can say, you can put a footnote, I must have a math error because this should be lower than the S&P return or something. That way, if you see a math error, I don't count out for math errors unless you should know it's a math error. So if you tell me this can't be right, I must have done something wrong, I can give you whole credit. If you like, sometimes students will transpose a number. So I don't count out for that, but you do need to know when that number can't be right. I'm always careful to set up the problem. I mean, I could set this up so that this is higher than that, but that would never exist in real life. That would mean I mispriced the option somehow. So I won't do that. So you can be for sure that's not going to be the case. Before we do the graph, everybody comfortable with this table? There are a few students that really struggle with the table, get really confused. The best thing to do is just work a few problems and practice.
Can you go back to the question?
No, not that one. No, not that one. I'll put this out on Canvas. Now, I'll even leave that first part up there. With
That would be
the,
the only question, right? Only like the math question? or-
it's the only, yeah, it'd be exactly this problem, just with different numbers. And I'll probably use the actual S&P level. I'm doing some really rough calcs to get the premium, because it's really hard to do a premium that long of a period. But so these are approximations. All right, so the last question. So we did this first part. How much we put into the bond, how many options to buy. We completed tables. The last part is this graph. You don't have Excel to do this, but to do the graph, you got the S&P at 975, the S&P at 3,800, and the S&P at 12,900. So equal-linked annuity, it has 1.5%, 1.5%, and 11.9. And then the S&P minus 12, 0, 13%. You're going to graph those, just a normal line graph, but yours will be by hand. I'm going to put in the title here. I don't know why Bill Gates put it over top of my data, but okay. Oh, it didn't give me the, I don't know. Oh, there it is. I don't know why Bill Gates does that either. The default should be low, and he makes the default in the middle. So you have to draw up something by hand that looks like that. What you're looking for is the hockey stick versus the slant. Most people, when they see this looks like a pretty good strategy. For a lot of people, they like that. You know, oh, the worst I can do is make 1.5%, but the market goes up and make pretty good returns. So I'm not saying I hate this investment approach. I actually like it a lot. I just don't like doing it in an equity annuity because of all the fees and the complexity. But it doesn't look like a bad product, does it? Looks pretty good. Looks like a pretty, and you can see why people would buy this just looking at that chart. All right, y'all have questions on that, on the chart? So make sure you know, this line should be straight, and I somewhat got it straight this time. This line should be pretty straight. So label and label. So you're talking, what happens if the S&P falls, stays the same, rises? You got the equity annuity, it looks like a hockey stick, and then you have the S&P, it just looks like a straight diagonal line. You are able to replicate this in Excel? That look right or not? Can y'all do it by hand? You might want to practice drawing it out by hand. So I have some students' graphs that are really almost impossible to read. So maybe bring a ruler or something so you can maybe halfway draw a decent graph. Or if you want to bring graphing paper, I would let you do that. Do they still sell graphing paper? You may not have even heard of that. We used it all the time when I was in school. It may not exist anymore. Now they have graphing calculators, right? You can just plug it in the calculator. So All right, questions on this?
But like the role of this like type of thing, that's what, like the actuary do this? Or
Actuaries don't get as involved in this because this is the deferred annuity. So it's really an investment product. The only thing the actuaries get involved in is what happens if the person dies before this thing matures. And they have the life insurance side. But yeah, this is one of those investment products. Remember, we said the insurance industry is into asset gathering. This is almost a pure investment product. So you don't need much actuary on this at all. Yeah, it'd be interesting. I wish I could talk some actuaries that work for a company like this. If you could almost build this entire product using just the finance department. So actuaries get involved when it matures and you have to pay someone $500 for the rest of their life. But this product is almost entirely an investment product. Other questions on this? And if you showed your grandparents this chart, say, yeah, I'd like a product like that. I mean, it looks pretty exciting, doesn't it? Worst case is you make 1.5%. If the market's really, really down, you'll get 12% instead of, I mean, the market's really up, you get 12% instead of 13%. It sounds too good to be true, but it's a very, very good product. I was trying to create a mutual fund to do this, but I could never get the lawyers to buy off on it. And the reason I like a mutual fund doing it is that we can keep the fees much, much lower than a life insurance company. So we can give a lot more of the value back to the investor. All right, I'll actually, I'll save this Excel as well and put it on Canvas. If y'all don't mind this being really hard to read. All right, so when I send out that weekly email, I'll include the problem from last year. Try to work it or definitely work it before next class. So you got 1, 2 that we've worked. Then you have another one in here. And then we'll work one more on Tuesday. So you'll have 4 problems in total. If you need more, I can create more, but it's going to get a little bit redundant. There's no tricks. There's nothing going to throw out. It's going to make it like, wow, I never saw that before. All right. I'm going to go to the notes on page 28. Finish up some more of this discussion on annuities. From a tax treatment, you probably already know some of this already. Their IRAs. The traditional IRA was created back in the 70s. And what it's trying to do is help people who don't have a company plan that they can get into. So it's hard, Roth IRA, if you got a 401k plan at your firm, you're going to be limited. You're contributing a lot to that. You can't like contribute the max to your 401k and contribute the max to an IRA. You just can't do that. So you're going to have to pick one or the other. Your 401k is probably the better investment because your company is probably matching that. The IRA and the 401k, the traditional IRA, they're very similar. You get it to invest with pre-tax dollars, which is great. So it's income you get that you don't have to pay tax on because you're going to put it in this vehicle. Same thing with your 401k. As you build it up over time, as you invest, it grows tax-free. But then when you take it out at the end, just like your 401k, it becomes taxable at that point. Right? It's something like with my own personal portfolio. I have IRAs, I have 401ks. It's like, so I know my net worth, but I'm thinking, wow, a lot of that is taxable when I take it out. Should I adjust my net worth for my tax rate? Is my net worth as high as I really think it is, or is it going to drop pretty dramatically if I take it? So we have all these all these investments that have grown tax-free. They're going to be taxable when they come out. So you have to be aware of that. I didn't update this for new rules, but we can look at it, how much and contribute to Roth or IRA in 2024. There was some like
Like 68.
There was some catch up they had, or yeah, they had one catch up. Sorry, 50 or older, it's 8,000, and then 7,000. I always contribute early in the year to get that deduction. So yeah, so 24 is the total. I guess we should ask 2023, right? That's the year we're in. That's 6,500. So it goes up next year. And you can do extra if you're over 50 to try to let people who aren't ready for retirement contribute a little extra there. So it's the same Roth, whether it's Roth or traditional. And insurance companies, banks, investment companies do both of them. So again, these are investment products. Anybody can sell these things. The only difference is on the life insurance side, there's some rules that may be different if you die before it matures. Other than that, they're exactly the same as the bank insurance and the bank and investment companies, other than what we already talked about. The life insurance products tend to have more fees. They tend to be more expensive, so they can be a little bit more challenged product. Investing in an IRA in a life insurance company, I'm not sure that's going to be your best bet. But there's also limits based on your compensation. So if you're only making 4,000 a year, you're not going to be able to contribute everything. So there's some limits there. Contributions can be made until 70.5, but I think that might have changed as well. When do I have to withdraw from traditional IRA? Because there's no rule on the Roth. When do I have to? That's when you can. That's not the end question. So it's still 70.5. I heard rumors, boy, I thought there was some law. I was reading about it that they may have added a year or two to that, but it doesn't look like. So 70.5. That's what I'm talking about with Danya. She turned 70, and that guy took all of her money out and caused her all those tax penalties. So 70.5. That's a traditional IRA. If you're covered by other plans, the IRS is not just going to let you get tax deductions or tax avoidance everywhere. And it gets much more complicated. So some of you are actuaries. There's a whole field of actuary on executive pay. I don't know if you actuaries have heard the executive pay side. I wouldn't do it. I wouldn't do a career that's entirely dependent on the US tax code not changing. So, but that is probably one of the most complicated actuarial jobs there are, because they have to know the actuarial side, but they also have to know the US tax code. So a good friend of mine, Mike, he was an actuary at UTSA that did those plans. He would get all the execs together. He would explain it for 45 minutes. And after 45 minutes, everybody's like, Mike, just tell us what to do. Everybody's completely lost. I have no clue what I'm supposed to do, because it's really, really complicated. So that's the whole area for actuaries. It doesn't feel like an actuary job. It feels more like a tax job, but they do have actuaries doing that. So those exec plans, the reason executive plans are called complicated is executives like to get paid a lot more than anybody else. They like to get tax deduction more than anybody else. And IRS says that's fine, but we have these non-discrimination rules. So yeah, you can pay your execs more. You can get more tax advantages up to a limit. But at some point, you're overdoing it for the execs, and then the whole plan gets out of kilter. So it gets pretty complicated. Distributions are taxed. Distribution cannot start before age 50 without a tax penalty, pretty significant tax penalty, but must start after 70. So if you take the money out too early, you pay a 10% tax penalty, plus you have to pay tax on your gains. And then when it comes out, you can look this up on, I don't know if y'all use this website. It's actually it used to be a horrible website, irs.gov, but now it's actually a pretty good website. Their search is much, much better than it used to be. You can just type in and you'll find reminder to IRAs over 70 have qualified charitable distribution. Well, there's all kinds, and you have to look through all of the points. But essentially what they're going to do is they're going to look at your age, not your life expectancy for you particularly, but for the general public. And essentially what they're going to do is, if you're 70 and a half and they think you're going to live another 15 years, they're going to make you take out 1/15 a year, essentially. so that they're going to try, so you essentially will run out of money when you die. So it will change every year and you have to get the tables. I'm not there yet. Those of you that think I'm over 70 and a half, I'm not. So I'm not there yet. I'm hoping that that's all going to come to me from the providers. I don't have to sit down and figure all that out on my own because I'm a CPA, but I don't like taxes. But we'll see. We'll see what my 401k provides, what my Roth provides, if I have to figure all that out myself. But I'm hoping they'll do that for me. And I have my pension plan, which I converted over the swap. So I've got three things that are all of a sudden just kind of when I hit. Now, my IRA is a Roth IRA. So do I care on that one? No, then it does, you don't care because it's never taxable. You don't get the tax deduction up front, but you get the deferral and then it's tax-free after that. So on that one I don't really care. I'm not worried about 70.5. And you can keep contributing later. There's no tax deduction. No required distributions because there's no tax. What can you buy in an IRA? They say just about anything. I've done options. I mean, you can short stocks. I mean, essentially it's a brokerage account. You can do just about anything except for life insurance. Can't put life insurance. I haven't ever done the math to see if it would make sense mathematically from a tax standpoint to put life insurance into one of these products. But I guess what they're saying is they don't want a tax favored plan to be in a tax favored plan. That doesn't make sense to me. It's kind of like putting municipal bonds. Why would you not put a municipal bond into a Roth IRA? Well, it's already tax free. Why would you put a tax free thing into a tax free thing? So, so you have this question you got to figure out on these things is where to put stocks, where to put bonds. And the traditional approach is you put stocks in the tax-free, you put bonds in the taxable. Because your thought is stocks are going to grow, be much more valuable, so you want them in the Roth IRA so they come out tax-free. And bonds, since they're lower return. But you got to be careful on these because, I mean, you may have to run some scenarios because stocks are usually taxed as capital gains, which is usually a lower tax rate than what bonds are taxed at. So it's not an obvious solution, but that's the traditional approach. You put stocks in the tax-free account, you put bonds in the taxable account. One thing I will definitely say is options, put that in the tax-free. That one's pretty obvious. Options are a pain for tax reasons. I don't know if y'all have trades options. It's just an absolute pain. At USAA, I did derivatives in the property and casualty insurance portfolio, and I did them in the pension plan. The pension plan is a piece of cake because there's no taxes. I could do whatever I wanted. The property and casualty one, it was a real pain because it was taxable, and the IRS hates options. IRS will tax gains today, and they will make you defer losses to future years. So if you're going to do sophisticated things where you could get massive gains, put that in your tax-free account. So set up, it's not hard to do, set up your Roth IRA with Schwab or whoever, I guess Robinhood does it as well. Set up that account. And if you're going to do options, put that in your Roth, set that up. So make sure you have to get that approval in advance. So there are some tax issues you got to look at because you're going to have taxable accounts and non-taxable accounts. So you've got to figure out what goes in which account. Because once you make that decision, it can be hard to move them to the other account. All right. I'm sure there's a lot more rules on this, and my notes are a little bit out of date, but not that far off. So how do you shop for deferred annuities? We talk about comparison shopping being difficult. If it's just a really straightforward deferred annuity, your main thing you're looking at is crediting rates. But the problem with that is they can change that rate every single month. So you can look historically at how competitive they've been. And even that's hard to get. It's hard to get a firm's historical rates. That's pretty tough. Most people, what they do is they just look at the current rate. And there's a lot of bait and switching going on where firms have a high rate, just get a bunch of new customers. They have some big deal. And then as soon as that money comes in, then they cut it back to a much lower rate. And they can, every single month, they can change the rate. There are surrender features. You definitely want to read those because those can be quite onerous. I had one person I was helping. She wanted to surrender a product. It wasn't exactly this product, but she wanted to surrender it. So we asked them to surrender. They sent her a check that was completely wrong. The amount was wrong. And so we called and said, okay, you took out too much to surrender. And they said, oh, sorry, we made a mistake. Send us the check back. We mailed the check back. They sent us another check for the exact same amount. So we called them again. And then they say, oh, the policy changed. I said, well, how could the policy change? They said, well, send it back and we'll send you the new policy. They sent me the new policy, the exact same wording as the old policy. That didn't help. Finally, they said, oh, we had an error in the system, and they were going to send us the right check finally. So you think these products are complicated, the insurance companies can't even keep track of it. So it was kind of comical, but frustrating for us, because the woman I was helping was like, do you know what you're doing, Ron? I said, yeah, I can read the contract. It's real clear. They should have sent you a much higher amount. And then there are guaranteed minimum rates. I've seen times where that's actually the biggest sell for me. So in 2008, y'all weren't alive then, or were you? Were you like 2 years old in 2008? So USAA was selling some of these annuity-like products, and I don't usually buy annuities, but their rate was ridiculous. The rate they were paying was higher than what the bond guy who was buying their bonds could have actually purchased. So essentially, they were making no money on it. So I call the actuary, says, why are y'all paying such a high rate? And he said, well, we haven't met our sales goals for the year, so we're just stacking the deck in December. So we hit our sales goal, but we don't. So it's okay, well, I'm buying one. And they're like, oh no, Ron's buying one. That can't be good. He's gonna tell all his friends. But I bought one, but not only was the rate ridiculously high, but the guaranteed minimum was ridiculously high. The guaranteed minimum was a number that was so high that when interest rates really fell, I was making a fortune. And then they were calling me and begging me to switch to another product. I was like, no, I like this guaranteed rate. I'll stay with it. So watch those guaranteed rates. They can be quite lucrative at times. And part of that is because, especially at year end, that's when you watch. At year end, they want to hit sales goals. They'll lose money on a few products just hit the sales goals because they get all of their commissions and bonuses and those kind of things. So if I were you, let me set this up how I do. I'll finish with this because I think this is important. So fixed income. The way I do fixed income, so you've got treasuries. Have any of y'all tried buying treasuries in your brokerage? I have a few charities, and I'll tell you why I'm buying treasuries, but I like treasuries. They're really easy to buy in your brokerage. So you have treasuries, you have certificates of deposit, you have bond, mutual funds, ETFs, and you have life annuities. The one I like the best is the EGA. There's one that has it's like a CD from an insurer. So I like them. They have like a 10-year and they give you a rate. That's what I bought from USAA in 2008. So they have a fixed rate. So it's a fixed rate. So it's not like these deferred annuities where they change the rate every month. These, when you buy them, they're called, at least at USAA, they're called EGA. So you just compare rates. So maybe the Treasury is paying 5%, CDs are paying 5.2%. Mutual funds, say, are 5.1%. Maybe, and this is kind of my case, maybe that's 6.5%. So which one would you do? Well, you look at that 6.5%, and it had a guarantee minimum. What the guarantee minimum meant is maybe this was a 10-year EGA, so it's going to pay me 6.5% for 10 years. At the end of 10 years, they're going to roll over to a new rate, but I have a guaranteed minimum what they roll it over on. And when mine rolled over, that guaranteed minimum was higher than anything I get anywhere else. So I like won twice on that. So I just look at these. What you're going to discover is treasuries and bond mutual funds. They're always going to pay whatever the market rate is. That's just a market rate. They have no control over that. They're just buying whatever is available. They're offering whatever is available. For CDs and life annuities, those are rates they set, and they can be whatever they are. And there are certain times they do really irrational things. I don't know if y'all noticed when Silicon Bank went under. He looked at CD rates at JP Morgan and Citibank, they're like 0.1%. Who's buying a 0.1% CD? But why were their CD rates so low? Because people were desperate to park their money with JP Morgan to get away from Silicon Bank. And so they just paid nothing. So you have to watch that. There are some things you have to be careful of. These two are very, very, very liquid. You can get your money out very, very easily. They're easy to sell. They're easy to get out. So they're very, very liquid. CDs, what happens in a CD once your money out early? Got to pay a penalty. Life insurance, very, very, it's the most complex. So if it's a tie, I'm going to go with the Treasury or the bond mutual fund. Okay. And you have to also consider tax deferral, right? So if you have these in a Roth IRA or whatever, then the tax deferral doesn't become an issue. But you got to look. So like with USAA, at the end of the year, they just racketed up that guaranteed rate. And I said, I'm going for it. I'm going to go buy that. So sometimes it's political, it's whatever's going on. Sometimes they're just not paying attention. I was at a credit union board and they weren't watching I think it was their 5-series CDs. And I was going to borrow money from them at 6%, and they had a 5-year CD paying 7%. And I'm on the board. I talked to the president of the company. I go, why are our CD rates higher than our auto loan rates? And his answer was, well, no one's buying them, so we just haven't been paying attention. It's like, okay, well, I'm going to buy one. Again, my second time, so I'm going to buy one. So sometimes banks are just not paying attention. So if it's a tie, you go with these. So what I've been doing recently with these, I invest for a lot of these charities, and it's short-term. So I'm buying short-term treasuries. Well, the last few months, treasuries have a higher rate than CDs. I always say I'm going to put the money in treasuries. Because if they need their money back, I just sell the treasury and get their money back. If I have the CD and I need the money back, I'm going to have to pay the penalty. So there are some other considerations, but you load these 4 things up. Make sure you have the same credit quality and the same duration. Don't look at a short-term mutual fund and compare it to a 5-year treasury. So make sure it's on the same comparison, and make sure you're not looking at some high yield fund or that you're with some bank like Silicon Valley Bank, unless you're under the FDIC insurance. But look at these rates. Usually the treasuries and the bond mutual funds will be in lockstep because they all move together. The treasuries will be lower because they don't have credit quality or credit issues. But these two are the ones to really keep your eye on, and they can shift quite dramatically. And the other issue you have is there's thousands of banks and thousands of insurance companies. So you're gonna have to find some way to go find these rates, and there's not a good place to go. At USAA, when we're looking at competitors, we actually had a staff that called every of our competitors and got their rates because there was no internet to go get it. Now you can probably go to the internet. How could you do it for certificates of bank deposits? Bankrate.com, or what I love with my Schwab account has CDs. It doesn't have life annuities, but I can go to Schwab, ask for CDs, and they just have a massive list of CDs. So it's getting better. It's getting better so you can more easily. Do y'all use Bankrate.com? And they'll show you CD rates all over the country. So if your uncle comes to you and says, he's looking at putting some money in bonds because rates are so much higher now, then, you can do some work to actually pick up some pretty good income by just paying attention to what's going on. Right? Comments on that? Any of y'all do it differently? All right. And then the last thing is administrative expenses, but that's going to generally come out of the crediting rate. But just be careful you don't have any other hidden expenses and fees, especially you don't want to give them $100,000 and they take $5,000 off the top. So just be careful. Make sure you read the fine print. Life insurance companies are notorious for doing some kind of shady. Some life insurance companies doing some shady stuff. All right. Next week, I'm going to start talking about this longevity annuity. So we'll start there. And then I'm going to get into it in much more detail when we talk about the benefit of survivorship. So we'll get into that. So any questions? How your paper 1 going? I got it finished. And your 2 essay questions, I got those finished, hopefully. So if you want to start meeting on the paper or the essays next week, just set up some time with me and come by. So, all right, I'll stop it there.